Okay, so we've spent quite a bit of time looking at statement of cash flows as it pertains to operating activities. Let's finish up this discussion by looking at some investing activities and some finance activities. So hopefully we already know the basic inflows and outflows for cash related to investing activities. So with that said, let's look at an example. It says assume a beginning balance of $125,000 in the long-term assets portion of the balance sheet. Now we're not talking about cash, we're just talking about assets on the balance sheet, non-cash assets. So it says accumulated depreciation for the year is $14,000. Exclusive of the effect of other adjustments, the net cash flows from investing activities to be reported on the statement of cash flows using the indirect method is, I'm kind of curious about this myself. Well, this is a bit of a trick here. They're attempting to get you to either add 14,000 or subtract 14,000, but this is a non-cash event. So let's see, the net cash flows from investing activities, exclusive of anything else, is zero. The fact that accumulated depreciation for the year is 14,000 means nothing, not for the investing activities section. It indirectly would mean something for the operating section, because if we have accumulated depreciation for the year, that means we have depreciation expense, but that only impacts the operating section of the statement of cash flows. Let's move on. All right, so assume the same $125,000 balance. It says a company sold a piece of equipment with an original cost of $25,000 and a net book value, not asset value, a net book value of zero for $3,000. Exclusive of the effect of other adjustments, the net cash flows should be reported how? Well, let's see here. We have 125,000. We sold 3,000. That's our answer. That's it. We sold a piece of equipment for $3,000. That is a $3,000 inflow from investing activities. That's all we have to consider is the amount of cash that we got. If we spent money, the only thing we have to consider is the amount that we spent. In this case, we got $3,000. That's the answer. That's all there is to it. I want to go back real quickly. We have a gain here of $3,000. The impact to investing activities cash flow is a source $3,000. That's a $3,000 gain, which will be an adjustment in the operating section as well, but we have a $3,000 positive source inflow, however you want to put it, for the investing activity section on this gain. Now, same company says sold a piece of equipment with an original cost of $25,000 and a net book value of $5,000 for $3,000. Same answer. The fact that we have a loss here and we had a gain on the previous slide means nothing. So if we were to sell these two assets and we had a $3,000 gain on one, we sold it for $3,000, net book value of the assets zero, and then we sell the other one, this one on this slide, for $3,000, and it had a net book value of $5,000, $6,000, because they're both inflows. Okay, we're not getting into gains, losses, anything else. The only thing that matters for the investing activities portion of cash flows, for the statement of cash flows, is how much we got, or again, how much we spent. So here we go. Summary. It says this is from all. It says assuming beginning balance of $125,000, we add $3,000 for the equipment sold at a gain, and we add $3,000 for the equipment sold at a loss. It doesn't say it here, but we also add nothing for the depreciation item. Okay, so 3,000 plus 3,000 is 6,000. That's the net change to cash flows from investing activities. So, cash flows from financing activities. This is something that most companies have a little bit more of. Almost all of our, if we were going to look at statement of cash flows and we were going to look at the numbers for the operating, investing, and financing, inflows, outflows, whatever number we have for operating, that's going to account for 97% of all of our cash transactions. Investing is going to be really, really small, minute percentage of transactions. And then finance is going to be the rest. So finance is a distant number two, a very distant number two to operating activities in terms of where cash flows come from and where they go to. Okay. So we've already know that we can issue debt. We can sell the company or sell parts of the company in terms of shares of stock. So that's what we talk about issuance. That would be an inflow. Repayment would be an outflow. So what are our pluses and minuses? Well, if we take out new loans or we issue new debt, that's a plus because we borrowed money. We got money. When we pay those loans back out of cash, well, that's a negative. Makes perfect sense, I hope. Dividends, draws, withdrawals, distributions, these are all the exact same thing. The proper term is dividends, but you may hear these other terms. When we're paying these out in cash, that's a negative. Should make sense. Cash received from owners for additional stock. This is really the same thing as the issuance of equity, stock equity. But when let's say that we're talking about a really small business, owner puts in $25,000 initially, and then maybe 6 months down the road, 8 months down the road, they put another $15,000 in. Well, that would be cash received from owners for additional stock in the company. All right, so it looks like we've got some activity here. It says, assume that a company has the following activity for the most recent year, January the 8th, received $20,000 from the shareholder, i.e. owner, in exchange for common stock. That just means ownership in the company, okay? On February the 11th, used a portion of the above funds to pay off a note payable totaling $11,600 at an interest rate of 6%. The interest rate doesn't matter. Then they issued or borrowed, they issued a 5-year note to a local bank for $10,000 cash at an interest rate of 4.5%. So you see what they're doing here. They had this inflow of money. They used it to pay off the higher interest note, and then they took out a little bit less at a smaller interest rate. And then on December the 21st, paid $5,000 in dividends. So look at this. It's 1, 2, 3, 4 transactions for the entire year. Now, in reality, you're probably going to have more than that, but hopefully you get the picture. Okay, let's see if we have anything else on this. So, just as you probably thought, the $20,000 received from the owner is an addition or a cash inflow. When we pay off the note, that's a cash outflow. New debt, inflow, and we paid dividends, cash dividends, outflow. So we add all of these numbers, pluses and minuses, we come up with $13,400 net change in cash from financing activities. What else? All right, so we have, looks like, the exact same statement of cash flows that we had before. Is that the truth or is that not the truth? I don't know. But if you recall with our balance sheet, I do remember that the beginning cash at the beginning of the year was $26,000. Cash at the end of the year was $97,500. Change in cash is $71,500. And then starting at net income and working our way down, we end up with a net change in cash, $71,500, which ultimately matches up with our cash balance at the end of the year. All right, that's as far as we're going to go with the statement of cash flows. We'll get some workout videos showing you how to work some of these problems up forthwith.